Welcome to the Deep Dive, your shortcut to being truly well-informed.
Today, we're diving into Walmart's latest numbers.
That's right, their Q2 fiscal 26 earnings and, crucially, their revised outlook.
We'll really unpack what's behind those headline figures.
And what it signals about, consumers and the wider economy. Ready?
Let's get into it.
Okay, so the big picture first. Walmart's Q2 consolidated earnings.
Yeah, total revenue came in at, $177.4 billion.
Exactly. That's up 4.8% year over year.
Which is solid growth for a company this size.
But, when you look at it in constant currency, stripping out those exchange rate effects.
Right. It's actually stronger. 5.6% growth.
That constant currency number, it really shows the underlying business momentum, doesn't it?
Absolutely. Currency fluctuations actually knocked off about $1.5 billion from the reported revenue. So the core demand is definitely there.
Okay, but then there's operating income. The reported figure was down 8.2%.
Yeah, that looks a bit concerning on the surface.
But again, the adjusted figure tells a different story. In constant currency, it was actually up, just slightly, 0.4%.
Right. And that adjusted part is key here. It cleans things up a bit.
Can you break down what adjusted really means in this context? Why is it so important?
Sure. Think of it as filtering out the noise. The reported income got hit by some specific one-off type things, discrete legal costs, some restructuring charges.
Okay.
And a really big factor was this headwind, about 560 basis points, so 5.6%, from higher self-insured general liability claims.
Wow, 5.6% just from that.
Yeah, imagine bigger than expected insurance payouts hitting the books. It impacts the reported profit, even if sales are humming along.
So the adjusted number gives you a better feel for the core operational health.
Exactly. It's like looking past a temporary blip.
Got it. And that flows into earnings per share, the EPS.
Yeah.
GAAP EPS was 0.088 cents, but adjusted was 0.68 cents.
And again, that adjusted figure excludes things not directly related to the core retail operations, like a gain from investments and those legal and restructuring bits we mentioned.
So 78 cents reflects the underlying retail engine more closely.
Precisely. And a huge part of that engine now is digital. Global e-commerce sales just surged, up 25%.
25%, that's massive.
It really is. And digital is becoming a bigger piece of the pie across all their segments, not just one area.
The CEO, Doug McMillon, he seemed pretty clear about this, right? Talking about top-line momentum from innovation.
Yeah, he pointed directly to, connecting with customers digitally, using AI. He sees tech as really driving things forward.
It's not just a side project anymore, it's central.
Definitely seems that way. Which leads us to the obvious question, what do they see coming next?
Their forward outlook. Let's dig into that revised guidance for Q3.
Okay, third quarter expectations. They're projecting net sales, constant currency again, to rise between 3.75% and 4.75%.
And that includes a small bump, like 0.2% from the Vizio acquisition.
Right. Operating income, also constant currency, is expected up 3.0% to 6.0%.
But that includes a bigger drag from Vizio, doesn't it?
Yeah.
About 1.4%.
Yes, that's factored in. And adjusted EPS for Q3, they're guiding for $0.58 to $0.60.
Now, looking at the full fiscal year, FY26, this is where it gets interesting. They actually raised their outlook.
They did. Net sales guidance, constant currency, was bumped up. It was 3 to 4%. Now it's that same 3.75% to 4.75% range they're forecasting for Q3.
That's a pretty confident signal for the rest of the year.
It is. And they also lifted the adjusted EPS outlook, went from $2.50 to $2.60 up to $2.52.62.
Even with a couple of cents headwind expected from currency changes.
Exactly. Which makes the raise even more notable.
But interestingly, the adjusted operating income guidance, constant currency, that stayed the same, 3.5% to 5.5% growth.
Yeah, unchanged. It suggests maybe they see strong sales, but they're also keeping a close eye on managing costs and profitability, perhaps anticipating some continued pressures.
Speaking of pressures, let's talk tariffs and consumer behavior. That's always a big piece of the puzzle.
Absolutely. And the CFO, John David Rainey, gave some interesting insights. He said they've started raising prices on some things.
But not everything. Selectively.
Right. A very targeted approach. And they're trying to offset costs elsewhere, bringing inventory in early, especially for Sam's Club, thinking ahead to the holidays.
And pushing those rollbacks, the temporary discounts.
Yeah, doubling down on that value message where they can. Rainey was pretty blunt, though, saying tariff-impacted costs are continuing to drift upwards.
So that pressure isn't going away.
Doesn't sound like it.
So how are shoppers actually responding? Rainey seemed to think consumers are holding up pretty well.
He described them as very consistent, resilient. He pointed to private label sales being roughly flat year over year as evidence.
There's not a huge shift to cheaper store brands, maybe.
According to him, not dramatically,
Oh,
but,
yeah.
well, CEO McMillan offered a slightly different angle, a more nuanced view, perhaps.
Okay.
He noted that middle and lower income households have been more sensitive, especially to price hikes on discretionary stuff, the wants, not the needs.
Ah, okay. So maybe not overall spending, but shifts within their spending.
Exactly. McMillan observed moderation in units as people switch to other items, maybe cheaper versions, or even switch categories altogether if something gets too expensive.
That makes sense. It suggests different income groups are feeling this differently.
It definitely does. It's not a single uniform consumer reaction.
And on the inventory front, you mentioned they're bringing stuff in early. Inventory was up, right?
Yeah, up 2.2% for Walmart US and about 3.5% for Sam's Club. That supports the growth they expect and helps manage that timing of getting goods in. It's a strategic move.
Okay, let's zoom in on the different parts of the business, the segments. Walmart US first.
Strong performance there. Net sales hit $120.9 billion, up 4.8%.
And the comparable sales, ex-fuel, that was the standout, right? Up 4.6%.
Yeah, beat expectations, driven largely by grocery and health and wellness.
What drove the comp sales? More people shopping or people spending more?
Both, actually. Transactions were up 1.5%, and the average ticket size increased 3.1%. That's a healthy combination.
And the e-commerce side in the US, still booming.
Oh, yeah. Up 26%. It contributed something like 4.2 percentage points to that overall comp sales growth. That's huge.
Wow.
And get this. Store-fulfilled delivery, where orders come from a local store, grew nearly 50%.
50%.
And about a third of those deliveries were expedited 3 hours or less. Speed is clearly key.
And their ad business, Walmart Connect.
Also growing fast, up 31%. That's becoming a significant high-margin contributor.
So good sales, good digital growth.
Yeah.
How did that translate to profit for Walmart US?
Well, membership income, like from Walmart Plus Day, was up 7.5%, which helps.
Yeah.
And the gross profit rate improved slightly by 26 basis points. Better inventory control and that high-margin ad revenue mixing in.
But expenses were up too.
Yeah, operating expenses grew a bit faster than sales, deleveraging by 43 basis points. A big chunk of that was that $400 million in higher-than-expected liability claims we talked about earlier, plus higher depreciation costs from Vizio.
So some headwinds on the cost side, but still strong performance overall.
Definitely. Strength across grocery, big growth in health and wellness pharmacy, optical, over-the-counter stuff. And even general merchandise saw low single-digit growth, gaining share in areas like fashion and auto care.
Okay, shifting gears to Sam's Club US, how did they do?
Also very strong. Net sales, excluding fuel, grew 6.0%.
And comparable sales.
Jumped 5.9%,
Yeah.
also excluding fuel, again, beating expectations. Driven by more units sold and more transactions, up 3.9%.
So good traffic there too. What about their digital side?
E-commerce also up 26%, just like Walmart US. It's now 18% of their sales, ex-fuel.
18%, that's a big chunk for a warehouse club.
It is, and nearly half of that e-commerce growth came from club pickup and delivery. And adoption of their Scan and Go app, where you scan items as you shop.
Yeah.
That was up about 600 basis points. That's a 6 percentage point jump in usage. People are really embracing it.
And membership, still growing.
Yep, membership income up 7.6%. Good growth in member numbers, renewals, and plus members.
But they face some operational challenges too, similar to Walmart US.
They did. Operating income took a hit from about $80 million in charges related to supply chain changes. And they also had that big impact from higher liability claims, about 710 basis points, or 7.1% headwind for them.
Ouch.
Yeah. But even with those hits, their adjusted operating income, stripping those out, and fuel impacts still grew a healthy 5.6%.
All right, let's look overseas. Walmart International.
Solid growth there, too, especially in constant currency. Net sales up 10.5% to $32.7 billion.
Where was that growth coming from mainly?
Really strong performances in China. Walmex, which is Mexico and Central America, and Flipkart in India. They saw more transactions and higher unit volumes pretty much across the board globally.
International e-commerce.
Grew 22%,
Yeah.
driven by store pickup, delivery, and their marketplaces. The global ad business grew 15%, mostly led by Flipkart.
But operating income internationally was down slightly in constant currency.
Yeah, down 2.8%. They put that down to strategic investments they're making for future growth, particularly in India, Canada, and Mexico.
So investing now for payoff later.
Exactly. Plus, currency swings hurt them too, took $1.5 billion off sales and about $0.1 billion off operating income in reported terms.
Okay, stepping back from the segments, let's touch on a few other key financial health indicators. Cash flow.
Looked good. Operating cash flow increased by $2 billion to $18.4 billion.
And free cash flow, the cash they really have left over.
That was up too. Increased $1.1 billion to $6.9 billion. That was helped by timing of payments, lower taxes paid, and the operating income growth, even though they spent more on capital expenditures.
So generating plenty of cash, what are they doing with it?
Well, they're returning some to shareholders. They bought back $1.6 billion of their own stock in the quarter.
And how effectively are they using their assets? Any metrics on that?
Yeah. Return on assets, ROA, was 8.3%. Return on investment, ROI, was 15.1%. Decent numbers, suggesting they're generating good profit from their asset base, although ROI was kind of flat compared to last year.
It's interesting to see how Walmart seems to be pulling ahead of some competitors, like Target.
It does seem that way recently. Walmart's focus on value, combined with faster delivery options, seems to be resonating. They're even attracting more higher-income shoppers.
Plus, those other initiatives like exclusive brands, expanding their online marketplace.
Right. It's a multi-pronged strategy that seems to be working well for them right now, helping them gain market share.
And you mentioned earlier, this is maybe the biggest digital story, e-commerce profitability.
Yeah, this is huge. They hit profitability for their U.S. and global e-commerce businesses for the first time ever back in Q1.
And in Q2,
They doubled that profitability from Q1.
doubled it. Wow.
It's a massive turnaround.
Yeah.
For years, everyone wondered if they could ever make money from their huge online investments. Now, it seems they've cracked the code.
That really changes the narrative, doesn't it? From just growth at any cost online to actual profit contribution.
Absolutely. It signals that digital isn't just a necessary cost center anymore. It's becoming a real profit driver for them.
So, wrapping things up, we've really dug into Walmart's Q2. Impressive sales, that e-commerce surge, managing pricing and value.
Yeah, and understanding those factors hitting profitability, like the liability claims and restructuring costs, but also how they're navigating those ongoing tariff pressures.
You should have a much clearer picture now of their performance and strategy.
And looking ahead, they raised their sales and earnings guidance, even with those cost challenges. It leaves you wondering.
What's the next big thing?
Exactly. What's the next frontier for retailers? Consumers clearly want value, but also incredible convenience. How will things like AI, even faster delivery, how will they keep reshaping how we all shop?
It feels like the pace of change is only accelerating.
Definitely something to keep watching.